We have a couple different strategies for handling losses, and this is very big because there's a lot of people having losses, pig butchering scams, or they might have rug pulls, might be fraud that shut down an investment. There's a couple different avenues for writing these off on your taxes. There's two primary methods, both of which lead to the same result, which is to have a deduction on Schedule A of your income tax of the net loss resulting from the theft. This would be in the case of a theft. A theft could be a rug pull, if there indeed that's what happened. If there's been an actual indictment related to it, then there's a Ponzi scam treatment, which is effectively the same treatment, but different paperwork. Another approach would be if someone's subject to a pig butchering scam where you lost the money, you're never going to get it back, but you can't really prove that that's what it was. You may have limited evidence as to who the perpetrators are. With that sort of thing, particularly pig butchering scams, and also with rug pulls, what you can write off or take as a loss is the amount of money you put into it. So imagine it this way: you put in over several purchases, say $10,000 into an asset, then is rug pull becomes worthless or near worthless. Maybe it's a pig butchering scam. You realize you're never going to get your money back. Think of that as though it's sold for $0 at the end of the year. And that's how you would treat the taxation on that. It would be short or long term accordingly. And you're basically getting a loss of the value you put in, your cost basis. You're not going to be able to write off the artificially inflated gains that they may have told you had made because they are fraudulent themselves. So all you can write off is what you put into it, which is a silver lining. You do get some money back from the government in terms of reduction of taxes for having suffered this loss. Nobody really wants to have a loss, but getting a tax break is a wonderful way to offset the pain.